Hey, what's up guys? It's Ezekiel Chiu here. So have you ever looked at a chart and thought, whoa, that move like came out of nowhere? So one moment the market is trending and then it turns sharply and you are left like asking, what just happened? Right, so here's the truth. That move didn't come out of nowhere. In fact, some of the sharpest reversal in the market happens at the exact same price zones again and again and again. And this is not by coincidence. This is what we call harmonic patterns. But here's the thing. If you ever tried to learn about harmonic patterns, you're probably going to come across tons of complicated Fibonacci levels, confusing X, A, B, C, D labels, and like mountains of stuff that all these people expect you to memorize. Okay, so let's be real. You're not going to memorize all of that. I didn't know about harmonic patterns until like years later when I was already profitable. And that's where I was like, wait, you mean this is harmonic pattern? So this is the only video on harmonic patterns that you need to watch. I'm going to like tear apart harmonic patterns in the simplest way possible so that you can spot them easily and more importantly, actually make money trading them. Okay, so first off, what are harmonic patterns? So harmonic patterns, they are price action formations where a series of price movement that follows a specific Fibonacci ratio. So when this consecutive price movement aligns with these ratios, price enters what is known as a reversal, like price reversal zone. And that is the area where the likelihood of a reversal increases due to what? Due to all the convergence of multiple Fibonacci levels. So it's like similar to candlestick patterns, chart patterns. Harmonic patterns, it helps traders to identify all the potential turning points in the market itself. Right, so obviously this is important. So we can divide harmonic patterns into two, bullish and bearish. So bullish harmonic patterns indicate what? A potential reversal to the upside. And then bearish patterns is like a reversal to the downside. So there are several types of harmonic patterns. So there are the bat pattern, alternate bat pattern, butterfly pattern, crab pattern, deep crab pattern, Gartley pattern, shark pattern, cyber pattern, 5-0 pattern, A, B, C, D pattern, 3 drives pattern, so on and so forth. Right, so this is where I'm going to go through each of these types and I'm going to break that down. So we're going to begin with the bat pattern. This is one of the most well-known pattern out there, right? So here we go. First off, I'm going to start by giving you the boring theory first. And you are going to understand why most traders, they give up learning harmonic patterns. The bullish bat pattern is structured through 4 distinct price movement, right? So this formation, it creates the characteristic of this pattern, right? And indicating a potential reversal to the upside after this pattern is formed. So to make the pattern easier to understand, we're going to label each of all these highs and the low as X, A, B, C, D. So this is a structure that most harmonic pattern follows. So the first step is to identify the initial 2 legs of the pattern. The first leg moves from the X to the A, which is followed by the second leg, which retraces from A to go down to the B. In the bullish bat pattern, the AB and the XA ratio must be between the 38.2% and the 50%. Okay? Anything that is out of this range is going to invalidate the pattern. To visualize this dashed line can connect X to B. So this marks the acceptable Fibonacci range itself. So now, unlike other patterns, we ignore the time distance between the points and solely focus on this vertical price ratio. So this is a key concept that is going to be clearer as we go along in this video. So now, the next step is to check the ratio between the third and the second leg. So which is the BC and the AB. So for a valid bullish bat pattern, the BC must retrace between the 38.2% and the 88.6% of the AB leg. If these conditions are met, the pattern now remains valid. So now, if the BC and the AB ratio is valid, this is where you move on to the next step. Checking the ratio between the C and the D compared with the B and the C. Alright, so now for a valid bullish bet pattern, the CD move must extend between the 161.8% and the 261.8% of the BC leg. So now, as a final step, we check the ratio between the A to the D and then the X to the A, right? So this represents the implicit price movement from A to D. So for most of the harmonic pattern, this ratio is about 88.6% of the XA leg. So why is it called harmonic pattern? The harmony of these proportions, it suggests a natural tendency for price to reverse after which. I mean, at least according to the harmonic pattern theory. So if all these conditions are met, there is a higher probability that price is going to reverse to the upside after point D. Okay, there we go. That is the theory part. Okay, and now I'm going to do the same for all the other patterns. No way, right? I'm not going to bore you with that. And besides, this is killing me to even go through that whole part of talking all the percentages. I mean, that's crazy. It's going to remember all these calculations. No way it's going to happen, right? So now, I'm going to show you exactly how I read it. Alright, so now let's go through the bet pattern now. Let's take a look at the bet pattern again, right? The bullish bet pattern. You know, like I told you earlier, I didn't know about harmonic pattern until like years later. And I was like, what? That is a harmonic pattern? Oh, this is what you call a bet pattern. Alright, so in the first place, when we look at this, right? Up, down, up, down. What is this to you? To me, this is a what? This is a double top. One top, two top. Right, the double top, usually the textbook theory is that it is a singular line where price respect it exactly. But sometimes, as you know, double top can go lower, sometimes it can go higher. Right, so either way, this to me is a double top, isn't it? I'm like, oh, okay, it's a double top. Right, so now, as you go along, that's where they're going to come with all these ratios, right? All these ratios, honestly, to me, it didn't really matter as much. Now, what intrigues me is that, you know, after a double top, there will be times whereby the market doesn't keep dropping down, right? Kind of came close to the previous level, which is around the X area, and then it kind of stopped there and then it reverses back up, right? So it's like going back up to test again, right? It's going back up to test again. To me, for example, if I were to enter, for example, let's say in a double top, if there is a price confirmation, I will enter at point C. It will go down. I will first look at point B and then probably go down to somewhere at point X. Now, at this point, I'm out, right? Most of the time. So this is the part whereby harmonic patterns and understanding of harmonic patterns is going to help you. Because now, with all this ratio, this is not just a double top that can potentially drop further. This is now a bullish bet pattern. Alright, so now when all these Fibonacci ratios are met, this gives the probability of this reversing upwards. So this is like trading progress, like I could actually enter from here now. Or for example, let's say if I enter from here at point C for a sell downwards, right? I can actually, let's say after I get out over here and I now know why price reverses back up, assuming there is no other support and resistance level over here. I now know why price reverses back up, and I can also look for opportunity with candlestick confirmation, with volume, with multiple time frames, etc. to go for a buy entry upwards here. So now this is how we progress in trading as we understand more. Now, this is helpful, isn't it? I'm going to keep going and I'm going to put them all together. All right, so now let's move on. In a bearish bet example, so let's take a look at this. So the bearish bet is just a what? It's just the opposite of a bullish bet. So to me, it's a what? It's a double bottom, right? But the bottom, at point C, it did not touch the support level of point A, but that's fine, that's fine. It's not going to be perfect. But because now with the understanding of, okay, this is a bearish bet, I now know this is not just a double bottom, it could be potentially a bearish bet, whereby it may not go up all the way to form a double bottom and reverse all the way, because the first thing first is that point C is slightly higher than point A. So this is my first indication, all right? So it may go up, but the overall trend is still down. It's probably not going to go up all the way. It's probably going to reverse back down. And besides, this is a bearish bat formation. If I'm going to take a buy order at point C for potentially a double bottom, I'm going to be careful right now because I now know that this is now a bearish bat formation, right? So I'm probably going to get out somewhere at point D because I now know that, hey, I should not get out at X because point D is going to be, based on the ratio, it's going to be about the 88.6% of the XA to XA area, right? So it's going to be slightly lower, right? So that's where I want to get out earlier. And you're also going to see why a lot of time price goes up, but it did not touch the previous level. It came lower to it and then dropped. Why? Harmonic patterns. Now you know. That's where when I realized that, oh, this is how I can add this to my knowledge base, right? So it's a learning progress. Trading is a learning progress. I'm still learning today. I've been trading for 25 years. I'm still learning every day, right? So now, with this understanding, we can now execute a sell trade from point D downwards. I will go for a buy trade for potentially from point C, right, upwards to maybe point D, right? And then from point D, I'll be potentially be looking to sell its way downwards. Okay, cool. Now, next, alternate bat pattern. What on earth is that? Basically, it's just a longer bat. It's a bat with a longer leg or longer wings. Right? That's if you compare the bullish bat, bullish alternate bat side by side with the bullish bat, you're gonna see it's just longer. Right? That's pretty much. Other than that, it's the same. We are just looking at where point X is gonna be. But now in this case, point D actually, or I would say this double top actually went down to the X level and lower. Earlier on, the bullish bat, it goes higher, right? It ended off higher than the X level. But now this ended off lower than the X level, right? So it's fine, right? So either way, if I'm selling at point C, I'll be careful, right? Because number one, I do not know for sure unless I match all the ratio to make sure that this is alternate bat. Okay, alternate bat, maybe my take profit can go slightly further from point X lower, right? But if it's a bullish bat, if I measure the ratio, I'll take my take profit slightly higher. I'm going to show you how to measure all this ratio later, the easy way, right? The easy way. All right, so ignore all these ratios for now. Just understand how are we going to use it. So now, when it comes down to point D, they'll be like, ooh. And then that's where we like, usually it's kept out, right? Usually it's kept out because the XA leg is so long. The C, if it goes down to point D, is usually kept out, right? Momentum cannot go down forever. It's going to reverse, right? And now, when you see this and you now recognize that this is a potential bullish alternate bat pattern for potential reversal upwards, that's the reason why we can buy at point D as well. Again, with candlestick confirmation, etc. So now, the bearish alternate bat is just the opposite. So I'm not going to go through that. Same thing, we execute from point D for a sell downwards. Quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. I mean, if you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. This is a bullish butterfly, right? If you see this bullish butterfly, I mean, they will connect and they draw the wings, kind of like a butterfly. Again, to me, it looks like what? It looks like a double top to me as well. No major difference, isn't it? No major difference. If you compare the bullish butterfly with the bullish bat pattern, it's not a lot of difference, right? It's not a lot of difference. Anyways, the ratio may be slightly different, so on and so forth. The angles, this and that, whatsoever, right? Maybe the whiteness of the wings, whatsoever, right? We are just looking at a pattern. It's the double top pattern, slightly lower, all right? Same thing, but in this case, point D is actually lower than X compared to the bullish bat pattern, right? So it's more like an alternate bat, bullish bat pattern, right? Anyway, same concept, we're gonna get in at point D upwards. Vice versa, bearish bat pattern, we're gonna get in for a point D to sell its way downwards. Same thing, nothing much of a difference. Bullish bat pattern, alternate bat pattern, butterfly pattern, all the same. Now let's move on. What on earth? It looks the same. Again, it's just probably slight difference again. Again with the names. To me, it's just a slimmer, longer version whatsoever of the butterfly pattern, right? The ratio may be slightly different here and there. Concept is the same. Double top, slightly lower than point A, right? We can sell at point C to go its way downwards, right? And then at point D, right? That's where we can go for a buy its way back upwards. The bearish crab pattern, again, it's the same thing. We're going to sell from point D downwards. So far, nothing much of a difference. Okay, now, another one. Deep crab pattern. So the crab go deeper, right? If you see the A to the B to the C, it goes deeper this way, right? Another variation of a double top, right? Ratios are different. You know, I'm putting all these ratios on the screen here. You want, you can copy them, right? Take a screenshot of them whatsoever. But main thing is the theory. Understanding how to apply it. Again, no difference. We sell from point C and then we buy from point D with extra candlestick formations, etc. Bearish dip pattern, same thing, opposite direction, right? A Gartley pattern, okay, slightly different now. It's not really a double top because it's more of like at the top, it's like a triangle, right? Like a triangle downwards. And here it's like a triangle too. Until point this line, the C kind of broke through the trend line to go lower down. You know, like this, some people may assume, right? If you point from point X to point B, if you draw the trend line up and then you draw the trend line down, initially this is a triangle, isn't it? Until this leg broke through the trend line at the bottom and then come down to here. So a lot of people are like, ooh, it's a triangle and the triangle has now broken. I'm going to go for a sell. But then they wonder, ooh, why did price stop at point D and then reverse back up? Oh, that is a false break. But what you now know is that this is a bullish Gartley. It's a Gartley pattern. You see, we learn, we evolve, we learn. So when we see something like that and then when we measure the ratios, all right, even though there's a false break, this area, when the ratios are met, right, I'm not going to sell off right here, even though it broke the trend line for a triangle breakout trade, right? But because it's so close to point D of the Gartley pattern, I'm not going to sell here. Instead, I'm going to wait. But and if the ratios met, if the system identifies this as a Gartley pattern with candlestick confirmation, I may actually look to buy here for the reversal back upwards. Okay? The bearish Gartley, the opposite, it's like a triangle, right? Until it's broken, right? It's like higher highs or higher lows in this case, right? And you know, sometimes like all the fake outs, like people thought, oh, break of structure. Point B is now broken, right? It's a break of structure. It actually went up. And then they realize that, hey, it's a break of structure, but why did it reverse back down? This area is a break of structure, right? Price actually went up above point B. It's a break of structure. But why did it go down? It can actually be a bearish Gartley pattern when all these ratios are met. Note, all these ratios are met. Sometimes it's the same pattern, but it's actually a break of structure because the ratios is not all aligned, right? I'm going to show you how to do that the easier way later. But when the ratios are aligned, that's where you know you don't want to go for a buy here, right? Even though this is a break of structure, because it's potentially going to be a bearish Gartley pattern. So now, before that, you'll be like, oh, I want to enter on break of structure, right? I want to go for a buy here. It's kind of like a breakout upwards, right? But now, when you spotted and it's identified as a potential Gartley pattern, you'll be like, oh no, I better not buy here. And in fact, if there is a selling signal over here, like a doji, for example, right? We can actually look, or bearish engulfing bar, we can actually look to sell here now, not just randomly, but because we now know this is a bearish Gartley pattern. Shark pattern is, you know how I identify? Like I said, it's a double top, right? But there are times whereby price go above the previous high. So this is the time whereby the point C actually goes above the previous high. That's where I'll be like, oh, I thought this is a double top, right? But now this is actually a shark pattern, right? This is a bullish shark. Same thing, price goes down, hits the bottom. Anyways, I'm going to sell here. If it's a double top, if there's bearish engulfing bars, patterns, candlestick pattern, etc., other confirmation, confluence at this area, I'm going to sell. It's going to come down to here, plus minus this area, and that's where potentially a reversal back upwards. Now I know this is now a bullish shark for me to place a buy over here. Same like all the previous bad pattern, etc., right? So bearish shark, same thing, vice versa. We can look to sell over here, buy over here as well, right? Now, next. Cipher pattern. cipher pattern, like the Gartley pattern, but the Gartley pattern is lower, right? The Gartley pattern is lower. This is higher highs. Higher highs. Alright, so that's why we kind of group together, right? Because the sheet pattern is higher high, which is why this followed. And then it came down, it broke below. Now, with this cipher pattern, it's actually, before that, it's an uptrend, potentially. Uptrend comes down low, makes higher high. Be like, oh, this is a false break. It comes down. Oh, it actually broke below the low. But now you understand this is a cipher pattern. We can actually buy over here, even though this point is lower than point B. A lot of times people are afraid. Oh, he has already broken a structure below point B, right? It's a break of structure. I should not be buying over here. It looks like it's going down. But now you know, no. These are actually harmonic patterns, and potentially I could also buy here with confirmation, and once the system identifies for me that this is a harmonic pattern, whatever names this is, provided that it matches the ratio. Bearish is the same concept, just the opposite direction for the sell downwards, right? Like a double bottom, go up before going down. All right, now next. Right, so 5-0 pattern, same thing, right? First, it make lower lows, all right? So it's not like a lower low, and then it broke up, it have a break of structure, it went up to point C, and then it comes down to point D, it did not break the below the lower low, and then it goes back up. To me, this is what is the flip zone logic. It went from a downtrend, lower lows, this is the high, it broke the high, at this point, it broke the high, right? It broke the high, at this point, it'd be like, oh, it could be an uptrend already, right? Broke the high, it come back down to test the area, it's like a demand zone, it tests the area over here, and then this is now an area. If you learn the supply and demand zone, right, this is a supply and demand zone, right? This is like a demand zone for you to go for a buy upwards to here. So if you see, all these terms are all interconnected when you understand levels, whatever names they may be, harmonic level, supply and demand zone, so on and so forth, right? You know, along the years when I trade, people start telling me, hey, you know of this concept, hey, you know of that concept. I'm like, I don't know, right? Can you share with me what is it, right? And then when they share with me, I'm like, oh, I'm doing that, but I just call it differently. So that's how it is. You need not, the key is understanding market structures. So for this is where we're going to buy, because it's changing from a downtrend into an uptrend to buy its way upwards. The key difference is that because of all these Fibonacci ratios, the probability increases, which is good, right? I always want to take trades with increased probability. Now I know that this is a pattern that matches a Fibonacci ratios. So the bearish pattern, same concept, just the other way, right? From uptrend to a downtrend where we go for a sell at point D. Now next. Alright, so now this is like a lower lows, right? But it's not like very steep low, it's like a slanted angle, right? Lower lows, right? But when it matches this ratio, lower lows at point D, that's where you be like, some people may like, alright, if it goes up, maybe it's just a retracement before going back down. But because this ratio now aligns, it becomes a bullish ABCD pattern, whereby it's more than just a retracement before going down, it's actually a movement for a reversal upwards, right? Because of all these ratios. Now, obviously, I'm not a mathematician, right? And all these ratios I already have done tons of back testing before it comes out, right? So I'm going to apply this knowledge. Does it work 100% of the time? No, it does not. Everything just adds on to the probability, right? Maybe this is just going to go up a little bit before coming back down, potentially. But maybe this is going to go up all the way at times. Either way, this is a potentially area for you to buy, even though this is making a lower low. Or at least I know maybe I should not sell, because once this is identified as a bullish ABCD pattern. Vice versa, for a bearish ABCD pattern, it's an uptrend, higher highs until it forms these angles, all these ratios before it drops downwards. Three-buy pattern is like price goes down, forms the X, heads up, forms a lower low to a B, heads up, lower high, forms another lower low, forms a D. Lower highs, lower lows, downtrend. But when all these ratios are met, this is now from the D upwards, may not be a retracement to go back down. This D upwards is now potentially a reversal to go up all the way. Now you know this is not out of nowhere, because the ratios are met, right? And then the opposite for is a bearish drive is higher highs, so it's uptrend, higher lows, uptrend. When the ratios are met, it's not going to go up. Potentially, is this the turning point for the D to go downwards? I'm going to cover one quick important thing called the time walk. So if you look at this time walk itself, the key is that harmonic patterns doesn't matter how far apart from one leg it goes to the high point. From one point to the high, from high to the low, from low to the high. That number of bars, the time duration does not really matter. So even if the pattern looks different, if you take a look at this, even if the pattern looks different, right, it remains a bullish bet as long as the Fibonacci ratios holds. So since the time duration is irrelevant, these variations are still considered the same pattern. Time duration does not matter. Is irrelevant for harmonic patterns. As long as they align the same, the pattern remains valid. So now I'm going to show you the easy way for us to apply the ratios in today's world. Okay, so now we are in trading view, right? And this is like a pair Euro USD. So what I'm gonna do, right? Like I said, it's nobody's gonna remember all the ratios, etc. Right? So nowadays, there's so many advanced indicators or tools that we can use. So for example, we go to indicators over here. I'm gonna type harmonic, and you're gonna see there's so many harmonic patterns, finder, etc. Right? So let's say if I'm just gonna choose one of them, right? Okay, now take a look at this. All right, so this is now added, and I'm just going to, there we go, right? And you're going to see, this is just one of the many indicators out there. It identifies all the patterns for you, the ratios and etc. Right there. This is just one of them. Like for example, if you look at the left here, I think there's this Gartley, this is bat, this is butterfly, so on and so forth, right? But what you can also see is that because it's so advanced these days, I mean, they're just showing you the past patterns of this specific pair, Euro USD, right? Let's say if this is the Gartley, there are 20 patterns found, right? So out of the 20 patterns, 20 trades, take profit 1, take profit 2, take profit 1 success is 55%, take profit 2 success is 30%, average return 0.19%, overall return is 3.81%. So as we can see, maybe the bet is not really good, but some of it is like really good, right? So I haven't gone into detail what is all this symbol represent, right? But anyways, in total, as you can see, like I said, this is not 100%. But if just you go blindly, I'm just saying, if this is true, if this backtesting report is true, if you just go blindly on this, the total return actually based on harmonic pattern itself is actually 15.69%. So it's positive, even without any additional confluence, confirmation, etc. Right? Candlestick patterns, etc. No. So this is like how you can use to identify certain patterns. So let's try another one, right? Let's try another one. And this is just one of them. There's so many out there, right? So there we go. You see, it identifies a bad pattern for you, a Gartley, etc. with all the ratios, so on and so forth. And like TradingView is just one of them. There's so many other platforms these days that has this function. And like what is also, even though if you don't have all these, they have, for example, this. Right, you can draw the X, A, B, C, D pattern, right? The head and shoulders whatsoever, right? You can draw like X to A to B to C whatsoever, right? To D. This is how you can plot them if you want. Honestly, like I said, these are just optional for show, nice to see for chart plotting. When do we actually use it? It's exactly how I shown you just now. What I just do is that we read the chart, we apply in this sense, it's kind of like an AI or chart pattern reader. We put it to there, it's like, oh, does it match any pattern? If it matches, good, it alerts me more, gives me more confluence. If it doesn't alert me, there's no pattern over there, I'm just going to trade the normal way. So this is like just an add-on onto what we have, but it's good that you know all the different terms, all the different patterns right now, such that when this happens, when the pattern comes out, you know exactly what you're going to do from here onwards. Harmonic patterns, what are they? They are all the different price shapes, right? That follows exact Fibonacci ratios, right? The key is to spot reversals. This is the goal of harmonic patterns. But they also allow you to know when you should not get in certain trades, had you not known that that is a harmonic pattern. Okay, so now the patterns can signal either a bullish reversal or a bearish reversal. We covered all the popular pattern names, right? The bat, the butterfly, the crab, the Gartley, the shark, the cipher, the 5-0, the ABCD, the 3 drives. They're probably going to be more, but the idea, the concept is the same. All these patterns, they follow a specific set of ratios, right? They are very precise, which is what we like, and that increases the probability. Remember, time warp. The timing of each leg from one point to the other point does not matter. Only the levels, the ratios matter. We talk about, once we learn one version, like the bullish version, the opposite is the bearish. It's the same. It's just a mirror image. Now, here's the keynote. All these patterns, they do not guarantee a reversal. Oh, it's gonna work out. No, it's not. They simply show you all the areas where a reversal is more likely, right? It helps in your reading of the market to enter at more better locations with other confirmations, like what I said, price action confirmation, candlestick confirmation, break of structure confirmation in lower time frames, etc. Get it? Good. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.